So we're back with our solo duo.
Another duet
With
the K.
What's going on with financing? What's happening with interest rates? What are you seeing out there?
When are
Rates going down?
There you go.
So what do they do when there's uncertainty? Banks don't like uncertainty, okay? They don't like risk. They just step back. So they're getting more part-time jobs. Hello.
There you go. All right, everybody, we are back at it, live in action in the studio, ready to go.
Wow, you're on fire today.
I am on fire. Just got another podcast, had a couple good calls. Today's Friday, summertime in San Diego. We're excited because everybody's left, so now we get to have our summer. But that's not why we're here. We're here today because we want to talk about what everybody, when they see us, they want to talk about. And Crystal, when everybody sees us, what in the world did they want to talk about?
What's going on with financing? What's happening with interest rates? What are you seeing out there?
No.
Is anybody doing deals?
And also is when are
rates going down?
There you go. Okay, cool. So that is the $1 trillion question, not the million, because that's when the rates come down. There'll be trillions of dollars of deals.
I wouldn't be sitting here doing this if I knew. Let's be honest.
Yeah, we write a book that says this is what's going to happen.
Yeah.
And so we're going to make this short and sweet just because we're really just going to focus on the rates. So I'm going to let Crystal go first. Crystal, let's just jump into it. First question is, what is going on, or more like it, what's not going on? Woo.
There's a whole lot of almost nothing going on. So I have seen over the last few months, people trying to pick up with activity. That's the thing I keep talking about. But as we all know, Treasuries went sort of buck wild the last few weeks. Well, 3 weeks, 4 weeks, whatever. Treasuries have been persistently higher. So this has caused some deals to fall apart, some people to back out, some people to change their mind. That's what I'm seeing more of, is that people are getting a little antsy, but they're kind of like, dude, things seem to be getting worse, not better.
So basically the word of some of us, uncertainty.
Lots of uncertainty, although most of us feel pretty certain that within the next 6 to 12 months, there will be a lot of deals to be had. So I think people are just now kind of they poked their head out to try to do some deals, and now they're kind of okay, not time yet. Let's give it some more time, maybe through the end of the year. Look at this thing again, the beginning of next year. That said, there's a couple of people who are super active in this business, in this market so far.
Well, there'll always be.
Two, super active. I'm talking about multifamily. I'm not talking about your side of things.
No,
I'm not talking about industrial or office or retail. I'm just talking about multifamily, because that's the majority of my business. That is, I'm literally seeing a few active players in the market today.
Yeah, let's just be real for a minute. I mean, if you listen to any real estate investor, CNBC that's big, has massive holdings, the biggest concern on top of the list is office, for sure. That's, just to go quick, that's because back to work, COVID really hurt them. And also too, major cities, let's just pick San Francisco. I'm going to pick on them, sorry, but they got
decimated. Basically.
Yeah, they got a bomb dropped on them, and they're having lots of problems. But the thing is a lot of people moved out of there. They're not going to the office. So office buildings that were worth $300 million are selling for $80 million.
Yeah, and let's be real too. This is the thing I want to say is I'm really talking specifically in the San Diego market. Every market is different. I'm actually doing some deals in other parts of California, other parts of the country. So I think, we're going to kind of see this happen in waves with the real estate market, because other parts of the country already went through this late last year, beginning of this year, and they're kind of on the upswing again. So now with rates, that's also causing some issues. But this is just pretty hyper local type stuff that you need to know. Where are you in the market? What kinds of things? Because there's opportunities in every market. Where are the opportunities? If the opportunities are not in multifamily today, 5+ units, where are they? They are somewhere. They exist.
Yeah, and I mean, I've had a lot of conversations with people, and also too, we've talked about, there's other markets that are probably, when we say doing better for buyers, probably not sellers, is there could be markets like Arizona or Texas where the cap rates are coming up. The problem here in San Diego is, Crystal, I might botch this number, is that 85% of the multiple family holdings here, are owned by mom and pop investors. Is that something?
Multifamily.
Right?
Yeah, it's super high number.
So basically, guys, what we're saying is it's not syndicators, it's not these big investors and all this. What we're saying is it's so most of those people that bought here, they put the 20, 30, 40% down. They're not doing these bridge loans and this. It's more mom and pop, old school buying.
And I am seeing more activity in the smaller sector. So like up to like, let's call it 3 million. There's actually some activity happening, right? Because you still have some of these guys who were originally flippers that turn into apartment owners that are kind of like, maybe I can just like flip some stuff here and there, do some things. And they're not worried necessarily about rates today. They're worried about them in a few years, or if they can make that quick pop of cash going forward. So there is some strategy there. But like what I'm hearing is that once you get above like that 3 million mark, it's kind of like, hello? Anybody
Bueller?
there?
Bueller? Yeah.
So the smaller stuff is trading because people have some cash. Like let's say in San Diego, if you have a couple $100,000 to throw at something, $500,000 to throw at something, you can do that. But now you're talking big numbers like million, 2 million, 3 million, where if the rate gets adjusted a 1/4% or 0.5%, you're talking about $500,000, $1 million more you might have to come to the closing table with. So the numbers get a lot steeper the bigger you go. So some of the smaller guys can actually be more agile. They can like figure out some of these ways to make money with value add or whatever, but it's just, vacation rentals, all these other things that people are doing. So there are opportunities in the smaller arena, and there is a little bit more competition. I'm saying like a little bit, but there's more activity happening in the smaller stuff.
So to kind of sum up, your rates stink because they're high.
I mean, the best rate we have today is pretty much 6.5.
Okay, so rates are higher than they were.
Yeah. I mean, you'll see brokers advertising these like high fives rates. It's like, okay, if it's a 1.5 DCR and it's 45% loan to value. So those are out there for those people. But I'm saying like, you want to go out and buy a property today, you want max leverage like the majority of the world, 6.5.
Okay, so rates are high, cap rates are low. It's not making much sense. Banks are dealing with the debacle of collapse. So they're adding spreads and margins, which all the above is just, they're scared, uncertainty. So they're stacking the rates probably even higher than they should be. And then on top of that, we have this thing, Basel 3, I think it's Basel 3, which just means, to sum it up, we don't need to go into the long story, is they're just going to require more requirements for banks to keep more liquidity, which is just going to affect the lending.
It's like have more liquidity and more auditing. They're like basically adjusting the threshold. So they're going to have to hire and staff up and stuff for that. And so not everybody really sees that as an issue, because if it gets passed, it happens. It goes into effect in 2028. But it is an issue because it's just a lot of complications and uncertainty, more uncertainty, in a time when they're already getting kind of hammered, like with CRE loans and all of that. Now they got to think about this Basel III stuff and like increasing their liquidity and hiring staff to handle all these like requirements and audits and everything. So it is actually a big deal. So it's kind of like a perfect storm of activity happening right now for banks. So what do they do when there's uncertainty? Banks don't like uncertainty, okay? They don't like risk. They just step back.
Yeah. So people that are buying deals or trying to assume loans or getting seller financing, or they're just getting shitty financing.
Yep.
Private money.
That's exactly
right. Or it's minimal prepay.
Talk to a private money lender. They'll tell you how busy they are.
Yep. Probably smart to get a private money loan with a minimal prepay, and so we're going to wait to the end to do where we think rates are going to go.
So what about you, Kenny, on your side of things? Because I actually see you doing more deals, but I think that's also, obviously the landscape's changed for you, and there's a lot of loan officers who...
Yeah, so same, quickly, rates are higher than they should be because, I'm going to go over real quick because I've said this a million times, but just to get it out there. Rates are higher than they should be because typically if you take the 10-year Treasury, which I'm not going to look at my phone, let's just say it's at 4.25, right? Typically you go 1.6 to 1.8 in normal market, which...
As a margin, correct?
Yes. As a spread.
The 10-year.
Yep. And if you add that up, if you took your calculator out, that number would probably not equal 7.
So it'd be like 6.
Yeah. Well, rates aren't at 6. Rates are 7+. So there's a lot of spread there. There's spread because of fear. There's spread because servicing companies, when they buy your loan, Mr. Cooper buys your loan from UWM and services buys the whole pool of a couple $100 billion of loans. If they don't keep that for 3 to 5 years, they are going to lose what we call money. And nobody's in the business of losing money. So they are now charging you an upfront fee basically to say, sure, we'll service your loan, Crystal and Kenny, but we're going to charge you a fee because we're not going to lose our ass when you refi in a year. So that's a big thing. We're lucky because we have Fannie, Freddie, Ginnie, and which is conventional FHA, VA, and all that stuff. So lending is always there. I'm not seeing.
You also have like the non-QM, the DSCR, the bank statements.
Yeah, I mean, so Fannie Freddie, I'm not really seeing much. The only thing they did is they went from minimal requirement, minimal months over 0 months for cash out to 12 months because they just don't want people taking money out. Because, you know, people.
So right now, if you bought a house within the last year, it's tough for you to pull some equity out.
You're not going to be able to do it through Fannie and Freddie. Exactly. So there's other options, but Fannie and Freddie, as you and I know, does most of the loans. They don't want probably people to pull money out because if you pull money out,
how easy is it to get a HELOC on your home? Is that fairly easy?
Yeah, that's what everybody's doing because most people have low rates, but those rates stink too. But I think people are just having.
You'd rather have a shitty rate on like 200,000 than have a shitty rate on $1 million or whatever.
But a lot of people are putting them on too because there's uncertainty for them. Am I going to get fired? Am I going to have a job, or is there an opportunity to do something? So there's that. Like Crystal mentioned, thank goodness the non-QM market, which is the secondary market, right? So basically, let's say there's 20, 10, whatever buyers that buy these loans. We're talking bank statement, DSCR, non-QM, all that stuff. They do jumbo, all that stuff. Interest only, closing LLC, all these. The rates are a little bit higher, but that is a very fluid market. They're loving the high rates. They're buying. If something really, really bad happened in the economy, or we had a thing, maybe like a virus go around, have you ever heard of a thing called COVID? Oh yeah, like a COVID. And we got shut down. They get uncertainty. They just turn the switch off like they did, right? Which we saw that. So the secondary market, the non-QM, you could always watch for that because if money gets tight or things get squirrely and that goes away, that is not a good sign. So that's fluid, it's healthy, so we have that and we have that. The jumbo market is not great. Why? Because as you know, banks have to lend their own money and the balance sheets and the Basel and also the whole thing. Jumbo rates and products are kind of like, they're not as...
Even if you go to like some crazy private wealth bank
I'm not talking rates. I'm just saying they're just tightening guidelines. They're getting a little more picky, things like that. So that's what's going on. As far as underwriting, honestly, I'm not seeing anything crazy. Don't get me wrong. Lots of deals are harder. If you talk to an underwriter that overlooks a lot of deals, they're like, oh, every deal's a pain in the ass. I think there's just a lot more challenging deals. But otherwise, are things pretty fluid? What am I really doing a lot of? Purchases. Yes, I am doing refis. People are like, what? Yeah, some people don't even have great rates. They're cashing out or getting out of hard money or fix and flip loan, or they just want cash and like, I'll take a higher rate because I think I can go, hey, I pay 7, but like Kenny, I can go flip homes and make 100% of my money. So they don't care. So that's kind of where we're at with rates and products. So my side's a little bit more healthier than your side.
Yeah, it is. Because I didn't even touch on that, like underwriting for our deals and stuff. It's definitely gotten a little bit more conservative. Like liquidity matters a lot more. Experience matters a lot more. So like a lot of these newbies who don't have any experience, that might be a little bit tougher to get through. It's not impossible. You just have less lenders who are willing to do it. And the underwriting is a little bit more conservative. So for example, like if I am at like a 1.2 DCR, they're still going to honor that. But what they're going to do is they're going to be like, you know what? Like I'm pretty sure utilities are going up next year. So I'm going to underwrite to 103% of utilities. 105% of utilities. So it just depends, and it cuts into your loan dollars. So whenever you want that max leverage, it's just going to be harder to find that because a lot of lenders are looking at this stuff a lot more conservatively because they want a buffer. I mean, think about it too. With inflation, we were using like $900 a unit for expenses. It's kind of like $1,100 a unit now for expenses. Plus, we say $1,100 plus. So you have a pool, you have an elevator, like you add on.
Plus your insurance has gone up.
Insurance costs have gone up.
For sure.
So you are getting hit, and like the thing is yes, we're seeing some price reductions. If you talk to brokers, they will see that. It's still not as it's still too far away from where rates are at. You know what I mean? Like if you're buying a 4.5 or even a 5 cap, you're still coming in with like 50% down on a purchase with rates at 6.5.
Doesn't make sense.
Yeah, it's crazy. Yeah. I mean, it is if you have money, but like, it's a lot.
Yeah. So I have my Monday blogs coming out, which you could send out to yours too. I gave use, as they say, use, New York, Jersey, use. I gave use what you wanted. I gave you a rate estimate. I'm telling you where I think rates are going to go. And how I did this
I did put that in my video that came out this week, just so you know.
I did a lot of research. What I did is I looked at what the Feds think. The Feds, I don't remember what it is. They think the 10-year Treasury by this time next year is going to be 3 or under 3. So 2.75 to 3 something, right? So if that's the case, even if the spreads are there, rates are going down. And if the spread comes down. So I predicted this time next year, we'll probably see rates on my conventional thing. I think I said, 5.25, 5.5 or something like that, conservatively. So I think you're going to see rates come down probably 1.5 to 2% because they are high. So I don't know what your prediction is. You can go read my Monday thing. I'm not going to, but that's because of data. That's because I think inflation, just all the stuff the Fed's looking at, inflation, jobs, job growth, consumer spending, all this. I think we're slowly descending, and then rates are slowly going to follow that. So I don't know what you're predicting. I think you're going to follow suit.
I basically predicted, because your rates tend to kind of be somewhat close to mine, but our rates are usually slightly better, to be honest.
Oh yeah, for sure.
So I predicted like 4.5 to 5-ish on the rates at this time next year. And generally speaking, yes, it was all the same information that you're talking about with inflation and all this stuff, but also keeping in mind that the Fed always overdoes it. So if they're saying this time next year, Treasuries are going to be there, I'm going to kind of like put a bet on the table that maybe it's going to be a little bit before this even, because they're going to have to start cutting rates sooner, in my opinion, my humble opinion, because I think we might actually have one more rate hike. So like, let's say in November, if we get one more rate hike, they're going to be like, oh shit, took it too far. We're going to have to turn this ship around pretty quickly. It's an election year. People have to be happy. We want to get votes. We want to do this. So it's kind of like a crazy big year, and they need to kind of like figure out a way to at least give the illusion that the economy is doing better.
Yeah, and Crystal made a good point there. I didn't come up with this. A guy, I forgot who it was, had a very good point, is think about it this way. The Fed's going to do all its work this year. So that means it's like Crystal said, they'll probably hike again. The reason why, even if they're like, they don't need to, they're trying to break something. They're trying to really make sure that they're slowing the ship, because 2024 comes, what are they going to have? They're going to have a lot of pressure from the political parties.
So do all the bad shit this year. You got to get it out of the way.
Just beat us while we're down. Kick us while we're down. This is what I think they're looking for. Number one, we're going to need to see that jobless claims, right? That number, that would have to be over 324 for probably like 4 to 6 weeks in a row.
Where are jobless claims now?
They just came out, the 200. No.
We're not there
So what I'm saying is that's one indicator.
Yep.
Second indicator is job wages, the wage growth. That's starting to soften. That means that you're not getting raises. So how are you going to keep up with inflation?
Do you guys want to know the craziest part about that? This jobs number? I mean, I know we're short on time, but like the thing about the jobs numbers is they don't tell you this. The full-time jobs went way down and the part-time jobs went way up.
Yeah.
So how healthy is the economy really when you have a bunch of people that are working part-time?
Well, I'm just going what I think they're going after, because then you can go into that.
And
I get what you're saying.
Crazy.
So then I think they're going to look at the consumer spending, which we know is slowing down. You guys are not consuming at the same level you were in the beginning of the year. There's no way. And it's going to slow. The other thing I'm telling you is October 1st, what happens, Crystal, to 45 million Americans?
I don't know.
Great. A good thing you listen to my content.
All their taxes.
No, that would be hundreds of millions. Student loan payments are due. You could push those off. The average payment is $350.
Yep.
And also October 1st, what is also that going to be? What's that going to be?
People run out of savings.
There you go. So when we were
we're already seeing something
when we were locked up, there was $2 trillion in this average American savings. Today there's $150 billion as September, and the burn rate every month is what?
150 million.
150 billion, not million.
Billion.
You wish it was million.
Yeah, billion.
No, actually, you don't. We'd already been. Yeah, that'd be a lot slower. So the burn rate's 150 billion. So we'll be out. So most people are thinking consumers second half of this year, especially coming to Christmas, are going to slow down. With that being said, like Crystal said, I do agree. The Feds are not looking at the data correctly. They're probably going to go overboard. Like we said, they're going to do the work this year. They're going to
When you have a bunch of part-time working Americans, what does that tell you? That tells you they're probably not getting the jobs they want, not getting the pay they need, so they're getting more part-time jobs. Hello. So they're not looking into this data, which is kind of interesting. I mean, how long have they been looking at data for? They don't know to look at this stuff. So anyways, I guess there's probably some reasons that none of us know about, but the data is not as rosy as they keep saying. It is not as resilient as they keep talking about. And so, like, to your point, I think that they're going to go ahead and hike rates in November one more time. And that's like, kind of like, why'd you do that? You know, things are already trending.
Unless the data is really...
unless we get some really good reports in the next month
okay,
or so.
So good. When Crystal says good, so bad reports are good reports, okay? So bad is good.
Yeah.
Okay, bad is good. So anyways, Fed's going to probably do all the work this year. This time next year, my prediction is the conventional rate will have a 5 in front of it for sure. Crystal thinks hers will have a 5 in front of it too. What does that mean? Well, I can tell you for me, if you don't have the inventory and there's a 5 in front of it, there's going to be a lot more buyers and sellers. So you guys know.
I mean, look at the market when we were around 5.5, like 2-3 months ago or whenever it was for that.
January.
For that, there was like that little window, right, where rates were kind of still in the mid to high 5s. Actually, for me, it was later. I think it was like March.
You're seeing more action then, huh?
Yes. Yes. So 5.5 will get people off the sidelines.
That's
6 will even probably get them to move a little more.
That answers your question.
Crazy.
Right there. Yeah. So we know you're going to get more people off the sidelines for residential. We have the ice age of real estate where a lot of people are trapped. They're not going to move. Guys, there's a lot of people who have 2s, 1s, and 3s. They're not going to move for a couple of reasons. Number one is the house, what they want now is so much more expensive. They're not have this nice low fixed payment. They're like,
even if they hate their house.
Redo it. So anyways, that is it. Thanks for listening.
Here's the rainbows and sunshine.
Thanks for watching. That's our update. That's the rate prediction. Rates are going in the 5s, maybe lower.
Yoo-hoo.
If we're wrong, we apologize. If we're right, we don't apologize. But anyways, thanks for watching. Please subscribe. Please like us. Please comment. Please share this with others.
Please write a review about how amazing we are.
Until then, we'll talk to you guys soon.
If you're already a real estate investor, you know that aside from cash flow, you also get huge tax benefits by investing in real estate. But are you taking full advantage of all the potential tax benefits? We've been working with Tim Looney at CSSI for a few years now, and he's saved us and our clients hundreds of thousands, if not millions of dollars in taxes doing cost segregation studies on their properties. Let me give you a few examples. We bought a property in 2019. If we had just used straight line depreciation, we would have saved about $18,750 in taxes. But because we did a cost seg, we saved $258,000. That's $239,350 more than standard straight line depreciation in the first year. The other great thing is, if you're classified as a real estate professional, you can apply this to other sources of income like W-2 or 1099 income, and you can also roll over any unused depreciation to future years. If you've owned your properties for a few years already, don't worry, you can still do a cost seg and save big on your taxes. This is not tax advice, so consult your CPA to see if you qualify to take advantage of these benefits. Call or text Tim at 318-469-9861 to get your complimentary property analysis. Once again, that's 318-469-9861. And I'll also include his information in the show notes. You guys don't want to miss out on these tax savings.